Welcome to the Real Estate Brief. My name is Zach Callilong, and we're going to be talking about some of the biggest headlines in commercial real estate over the past week. So buckle on in. Blackstone has successfully closed an $8 billion fund focused on providing debt financing for commercial real estate projects. This fund will supply loans for acquisitions, developments, and refinancings, filling a gap left by traditional lenders who have become more conservative. This significant capital raise signals strong investor confidence in the real estate debt sector. $8 billion in a climate where traditional lenders are tightening their belts. Blackstone's move is a significant vote of confidence or perhaps a calculated gamble. This influx of capital could stabilize certain projects, but it also raises questions about the long-term implications of relying heavily on private debt. Are we seeing a strategic market correction or simply shifting the risk to a different playing field? Either way, someone is about to get very wealthy or very stressed. Bit of both? Who knows? Data from the General Services Administration, or GSA, shows a continued decline in federal government office space occupancy, with a reduction of 8.5 million square feet in February. This trend reflects the ongoing shift towards remote and hybrid work models within federal agencies, impacting office markets nationwide, particularly in cities with high concentration of government offices. The ongoing decline in federal office space isn't just a matter of empty desks. It's a fundamental shift in how we envision work. While some might jokingly suggest turning these spaces into indoor gardens or pickleball courts, pickleball sounds pretty good, the reality is that this trend has serious implications for urban economies. Landlords and city planners are facing a challenge: how to repurpose vast amounts of space in a market already grappling with oversupply. Maybe bring free coffee back to the office, might help. Data suggests that small multifamily markets, specifically properties with less than 50 units, is showing signs of stabilization and potential recovery. This indicates a growing demand for affordable housing options in a smaller, suburban, and rural areas, which are often less volatile than urban markets. Lenders in New York City multifamily markets are tightening loan terms, demanding personal guarantees and recourse from borrowers. This reflects a heightened sense of risk aversion due to concerns about rising interest rates and increased operating expenses, and potential rent regulations. The dichotomy in multifamily market is striking. Small markets are showing resilience driven by affordability, demand for diverse housing options, but meanwhile, lenders in high-cost cities like New York City are demanding ironclad guarantees. This isn't just about risk aversion. It's a reflection of deeper concerns about regulatory uncertainty and market saturation. It's like watching two different economic realities play out side by side. One is a nice, relaxing day at the park, and the other is a high-stakes poker game. I don't know about you, but I only play high-stakes poker. Savannah has secured $380 million in construction financing to complete a luxury residential project in West Palm Beach, Florida. This significant investment highlights the continued strong investor interest in the Florida real estate market, particularly in high-end residential development. Target has announced ambitious growth plans aiming to increase its annual sales by $15 billion by 2030. This growth will be driven by expanding its grocery offerings, enhancing its digital shopping experience, and opening new stores, impacting retail real estate demand. Florida's continued appeal to investors is undeniable. But let's be clear, luxury condos and retail expansions aren't just about catering to the wealthy. They represent a significant economic force shaping local markets and influencing a broader trend. While some might scoff at the idea of retail revolution, Target's strategic growth is a testament to the enduring power of brick and mortar in a digital age. All those condos? Well, someone has to buy them, even if it's just for the winter. An AI-focused software company in San Francisco is doubling its headquarters size due to rapid growth, driven by the increasing demand for AI-related products and services. A consortium of banks has provided $2 billion in financing for construction of a large-scale AI data center near Salt Lake City, highlighting the growing demand for data center infrastructure to support the expanding AI industry. This contrast in Silicon Valley are a microcosm of the broader market, decline and growth side by side. The shift from traditional office space to an AI-driven infrastructure is a profound transformation. This isn't just about tech. It's about the very nature of work and commerce. While some might dismiss data centers as glorified server rooms, they represent a foundation of the next economic era. The New York City office bond market, which has slowed down, is slowly showing signs of recovery, indicating renewed investor confidence in the city's office sector. The resurgence of New York City office bonds is a welcome sign, but it doesn't erase the challenges facing the city's commercial real estate market. This isn't a return to the status quo, it's a recalibration. Investor confidence is crucial, but it must be accompanied by strategic adaptation and innovation. It is good to see that the city is showing signs of life, but they still have a long road ahead. And that's it for this week. Don't forget to subscribe because I'll see you in the next one, or not. If you don't want to see them, you don't have to.